When we think of a family trust here in South Africa, it is, it's incredibly easy to imagine this massive fortress.
Oh, absolutely. Like a stronghold.
Yeah. Picture these thick stone walls, a heavy iron gate, and a moat. And it's all designed to protect your family's hard-earned wealth from the outside world.
Right, because if you own a business and things go south.
Exactly. Or if you face a sudden lawsuit or just general economic turbulence, those threats basically just bounce right off the walls of the trust.
The visual of a stronghold is incredibly accurate, actually. I mean, the entire purpose of creating that legal structure is to separate your personal risk from your family's long-term security.
Right.
It provides this massive amount of comfort, knowing those assets are tucked safely away behind those thick stone walls.
But here's where the entire system usually just falls apart.
Oh, yeah.
You build this impenetrable fortress, and then you leave the back door wide open.
Yeah.
And not for a thief or a creditor. You leave it open for your own family.
Which is so common.
Right. You let a beneficiary, maybe your child or a sibling, just move into one of the trust's prime properties.
Yeah.
And you let them live there rent-free. Or, maybe for pennies on the dollar.
Just because they're family.
Exactly. And suddenly, that fortress isn't just compromised. It basically becomes a handwritten invitation for the tax authorities to audit you.
100%.
And it's a guaranteed recipe for a massive family feud.
That instinct to just let family use the assets freely is, it's the absolute definition of a well-intentioned disaster.
Yeah.
You go to the trouble and expense of building this sophisticated protective vehicle, and then you unravel it entirely from the inside out, simply because you treat it like a personal piggy bank instead of a distinct legal entity.
Which brings us to exactly what we are unpacking for you today. In this deep dive, we are exploring the highly lucrative yet legally delicate world of family trusts in South Africa.
It's a minefield.
It really is. We're specifically looking at the mechanics of renting trust property to your own family members, drawing from a really comprehensive guide we have today called Renting Trust Property to Beneficiaries, a strategic tax guide.
Such a crucial topic.
Because having a family trust is a phenomenal wealth-building tool. But we are going to dive into how to manage the real estate inside it so the trust actually works for your family and not against it.
Yeah, and to really grasp the stakes here, I think we should anchor ourselves in why South African business owners and families utilize trust so heavily in the first place.
Right. What's the baseline?
Well, the benefits are substantial. First, you have asset protection, like you mentioned, shielding properties from your personal or business creditors. Second is estate planning. By keeping assets out of your individual estate, you drastically reduce estate duty and executor's fees when you pass away.
Which can be huge.
Massive. And third is wealth preservation. You're ensuring that a family farm or a portfolio of properties remains intact across generations.
Rather than being chopped up and sold off to distribute an inheritance.
Exactly.
Okay, let's unpack this, though. Because if the family trust owns a great house in the suburbs or a beach house, isn't it kind of like a family cabin?
Ah, the family cabin analogy.
Right. I mean, the whole reason the trust was set up was to benefit the family. So why can't a beneficiary just take the keys and move in? They're family.
Well, that instinct right there is exactly what gets families audited and sends siblings straight into courtrooms.
Really?
Oh, yeah.
Yeah.
Because the legal reality is that the beneficiaries do not own that house.
The trust does.
The trust owns the house.
Yeah.
And the trustees, the people appointed to manage it, they have to adhere to very strict fiduciary duties.
Okay.
They are legally obligated to act in good faith, avoid conflicts of interest, and most importantly here, treat all beneficiaries impartially.
Ah, so it's not just about the tax man, it's about the siblings.
The sibling dynamic is often the most volatile part of this whole thing.
I can imagine.
Just imagine a trust with 3 adult children as equal beneficiaries. The trust owns a beautiful property. If the trustees allow one of those children to live there for free, the trust is forfeiting the rental income that property could generate on the open market.
Right.
And that lost income is money that should be growing the trust's capital for the benefit of all 3 children.
Oh, wow.
So by giving one sibling a free ride, the trustees are actively prejudicing the other 2.
Yeah.
They are fundamentally failing in their fiduciary duty.
So the legal boundary is very clear, which leads us to the single most important rule of managing trust property, the absolute golden rule that solves the entire tension.
Yes.
And that rule is market-related rentals.
That term market-related is critical. It basically means calculating what an entirely unconnected person would pay in a strict arm's-length transaction.
Like a total stranger.
Exactly. It's the rent the trust would command if the trustees put a listing online and picked the most qualified stranger to move in.
So let's look at how this plays out in the real world with the scenario. Let's look at a family we'll call the Thompsons.
Okay.
The Thompson Family Trust owns a three-bedroom house in Durban, valued at around 2.8 million rand. Now, Sarah Thompson, one of the beneficiaries, wants to live there as her primary residence.
Right.
So the trustees don't just sit around a braai and guess a friendly number. They actually research comparable rentals in that specific Durban suburb.
That's what they have to do.
Yeah, they get written valuations from two independent estate agents, and they determine the market-related rent is 15,000 rand a month.
And furthermore, they don't just agree to this verbally. They sign a formal, legally binding lease agreement with Sarah.
A real lease.
A real lease. She is contracted to pay 15,000 rand a month, complete with a standard 6% annual escalation clause, just like any other tenant.
Which means the trust is now generating 180,000 rand a year in legitimate income.
Yeah.
And Sarah gets to live in a secure, well-maintained family property, but her siblings have zero grounds to complain, because the trust is making the exact same amount of money it would if a total stranger lived there.
The fairness is baked right into the math.
It is.
And from a compliance perspective, the trustees have basically bulletproofed the trust against the South African Revenue Service.
SARS.
Yep. Consider the alternative. What if they decided to be nice and let Sarah live there for, say, 8,000 a month when the market rate is 15,000?
Uh-oh.
SARS has the authority to look at that 7,000 rand monthly shortfall and classify it as a deemed donation from the trust to Sarah.
And donations tax in South Africa is 20%. That is a massive penalty.
It is a devastating and entirely avoidable penalty.
Yeah.
The trust would owe 20% on that accumulated shortfall every single year, and the trustees could literally be held personally liable for that financial damage because they breached their fiduciary duty to maximize the trust's returns. So sticking strictly to a market-related rent creates a defensible, transparent arrangement that protects everyone.
But wait, I know what you might be thinking right now listening to this, because I am thinking the exact same thing.
What's that?
If you have to pay full market rate rent to your own family trust, doesn't that entirely defeat the financial perk of having a family trust in the first place?
It sounds like it, doesn't it?
Yeah. Like, why go through all the administrative headache of trustees and lease agreements if you're just paying the exact same rent you'd pay a random landlord on the open market?
That skepticism is completely warranted.
What?
But the answer lies in how the trustees manage that rental income once it flows inside the trust structure.
Okay.
This is where we see the absolute magic of trust distributions. You can, legally and highly efficiently, subsidize a beneficiary's living costs without violating a single tax law or fiduciary duty.
Here's where it gets really interesting. Let's look at another scenario from our sources, the Harrison Trust.
Let's do it.
So Michael Harrison is renting a townhouse in Johannesburg from his family trust for 16,000 rand a month. Over a year, that's 192,000 rand in rental income flowing into the trust.
Right.
Now, obviously, the trust has expenses for that property, things like complex levies, municipal rates, general maintenance. Let's estimate those expenses total 36,000 rand for the year.
Okay, so that leaves the trust sitting on a net rental income of 156,000 rand.
Exactly.
The critical mechanism here is trustee discretion. The trustees have the power to decide what to do with that 156,000 rand net profit.
Right.
So they hold a meeting and decide to distribute it equally among the trust's three beneficiaries. So Michael receives 52,000 rand, his sister Emma receives 52,000 rand, and their mother Patricia receives 52,000 rand.
It's genius because the distribution is a legally distinct, completely separate transaction from the lease.
Exactly.
Michael is fulfilling his obligation as a tenant by paying his full market rent of 16,000 a month. That satisfies SARS, and it satisfies the trust's fiduciary duties. But then, as a beneficiary, he gets a 52,000 rand distribution at the end of the financial year.
And to fully appreciate this, we really need to look at the tax arbitrage happening behind the scenes.
Okay, break that down.
Trusts in South Africa are heavily taxed entities. If the Harrison trustees simply retained that 156,000 rand of net income inside the trust, it would be taxed at a punitive flat rate of 45%.
Wow. So the trust would lose almost half of that income straight to the taxman if it just sat in the bank account.
The tax burden would be enormous. But the law allows trusts to distribute income to beneficiaries through what is known as the conduit principle.
The conduit principle.
Yeah. By distributing the income, the tax liability flows through the trust and lands on the beneficiaries, who are taxed at their individual marginal tax rates.
And most individuals are sitting in a tax bracket far lower than 45%.
Exactly the point. Let's assume Michael is relatively early in his career and his marginal tax rate is 36%. When he receives his 52,000 Rand distribution, he pays his 36% tax on it, which is roughly 18,700 Rand. This means he pockets over 33,000 Rand after tax.
Okay, let's do the final math on that. If we take that 33,000 Rand clear cash he gets back and subtract it from the rent he paid over the year, his true effective monthly cost for that Johannesburg townhouse drops from 16,000 Rand down to roughly 13,200 Rand.
He secures a perfectly legal, heavily discounted cost of living.
That is amazing.
And, crucially, at the exact same time, his sister Emma and his mother Patricia each receive their 52,000 Rand distributions as well. So there is zero resentment at family dinners.
Everybody wins.
Exactly. The siblings are getting their fair share of the assets yield.
So going back to our earlier metaphor, you get to keep the fortress walls up so SARS can't attack the structure, but you lower a financial drawbridge for the beneficiary through these distributions.
The drawbridge is the perfect way to look at it. And this strategy is incredibly malleable. The real power of discretionary trusts is their flexibility to handle different seasons of a family's life.
Let's run through some very different family dynamics to see how this adapts. First, the elderly parent.
A very common scenario.
Right. Imagine the Anderson Family Trust. The founder of the trust has passed away, and his widow, Margaret, wants to live in a comfortable cottage on one of the trust's properties.
Yeah.
But Margaret is on a fixed, very limited pension. She literally cannot afford a massive monthly rental.
Well, the trustees cannot just waive the rent because of everything we've already discussed.
The golden rule.
Right. So they charge her the independently verified market rent, let's say 8,000 Rand a month. But recognizing her financial vulnerability, the trustees use their discretion to distribute the entire net rental income, perhaps 7,000 Rand after property expenses, straight back to her.
So her effective out-of-pocket cost becomes just 1,000 Rand a month.
The cash flow circles right back to her.
Yeah.
And the adult children, who are the other beneficiaries, they usually fully support this resolution because it provides for their mother safely, legally, and without putting her in an undignified position of, begging for cash.
I love how clean that is. What about the other end of the spectrum? The young graduate.
Ooh.
Take the Cooper Family Trust. Sophie has just graduated university, landed her first job in Joburg, but she's on a modest junior salary.
Right.
She rents a secure apartment owned by the trust. They set the lease at the full market rate of 9,500 Rand.
So the rent establishes her responsibility. But separately, to help her bridge the gap between her entry-level salary and the cost of living, the trustees vote to give her a 6,000 Rand monthly distribution.
Brilliant.
Again, two separate ledgers. The market rent protects the integrity of the trust and the siblings' future inheritance, while the distribution gives Sophie the legitimate family support she needs.
Yeah.
And the beauty is, as she gets promoted and her salary increases, the trustees can gradually reduce that distribution.
It's a built-in weaning process.
Yes.
And this framework even solves the ultimate family battleground.
Oh boy, the shared holiday home.
Yes. The Mitchell Family Trust owns a beautiful beach house down in Bolito. No one lives there full-time, but of course every single sibling wants it for the December holidays.
Naturally. Well, setting up a permanent lease doesn't make sense there. Instead, the trustees implement a formal booking system with a daily usage fee.
Okay.
Let's say 1,500 Rand a day, which aligns with short-term holiday rental rates in the area.
It totally removes the emotional friction. You want the house for Christmas. You log into the system and you pay the daily fee just like you would on Airbnb.
Precisely.
That fee covers the property's running costs, maybe generates a little profit for the trust, and ensures that the sibling who uses the house the most is paying for the privilege.
Rather than freeloading off the family's shared asset,
Right.
the financial boundary preserves the family relationship.
But let me throw a wrench in this.
Go for it.
What if a beneficiary isn't just passively living in a property? What if they are actually working there? Let's say it's a family farm, and one of the sons is running the day-to-day operations. Do they still have to pay this full market rent just to live where they work?
So the structure shifts in that scenario to what is known as a caretaker arrangement.
Caretaker arrangement.
Yeah. Consider a trust that owns a large rural property in KwaZulu-Natal. The beneficiary, Robert, lives on the farm, but he is actively managing the agricultural operations, overseeing the staff, maintaining the buildings.
So he's effectively an employee.
He is providing a commercial service. Therefore, his arrangement is documented as a service agreement, not a standard residential lease.
Interesting.
The trustees determined that Robert's management services are worth 15,000 rand a month. Simultaneously, they calculate the market value of the farmhouse he lives in is 12,000 rand a month.
Okay, so how do they balance those two numbers? Do they just wash?
Well, they provide him the accommodation rent-free, but they classify it legally as a fringe benefit against his management services. So his total compensation package is 27,000 rand, the 15K in cash, plus the 12K in housing. This reflects a fair market package for a farm manager.
That makes a lot of sense.
Robert pays personal income tax on that fringe benefit, and the trust deducts the management cost as a legitimate operating expense. It is a genuine, heavily documented commercial exchange.
Okay, I'm following the logic. And all of these scenarios sound perfectly orchestrated.
In theory, yes.
Right. But they all assume you are building this architecture properly from day one. What happens when a trust is carrying around messy historical baggage?
Real world.
Yeah, I think every family has that informal handshake agreement made a decade ago where Uncle Dave just moved into a trust property and pays whatever he feels like whenever he remembers to.
Stepping into those legacy arrangements puts you squarely in the danger zone.
I bet.
Informal agreements are a massive liability today, largely because of a seismic shift in South African tax law back in 2017, specifically Section 7C of the Income Tax Act.
Section 7C. This is the piece of legislation that still gives accountants nightmares, isn't it?
It fundamentally changed how trusts operate. Historically, a wealthy individual might give an interest-free loan to their family trust to go buy a property.
Okay.
It was a brilliant way to move growth out of their personal estate without paying tax. Let's say a father gives his trust an interest-free loan of 3 million rand to buy a house. Before 2017, the tax man basically ignored it.
But today,
Under Section 7C, SARS looks at that 3 million rand interest-free loan and says, wait a minute, in the real commercial world, you would have charged interest on that.
right.
So they apply an official rate, let's say it's currently around 8%, and they treat that foregone interest as a continuous annual donation from the father to the trust.
Oh, wow. Let me do the math on that. 8% of a 3 million rand loan is 240,000 rand a year.
Yep.
SARS sees a phantom 240,000 rand donated every single year, which triggers that 20% donations tax we talked about earlier.
Exactly.
That's an actual tax bill of 48,000 rand annually?
Yeah.
Just because you tried to help the trust buy a house?
It is a brutal annual penalty. However, this is where the market-related rent comes to the rescue.
How so?
If the trust is charging a beneficiary market-related rent for living in that house, the trust is generating actual cash flow.
Right.
The trustees can use that rental income to pay the father actual tax-deductible interest on his loan instead of keeping it interest-free.
Ah. So charging the beneficiary rent literally funds the solution to the Section 7C tax problem.
It's an elegant solution.
That is an incredible mechanism. But practically speaking, how do you actually fix an old handshake deal without causing a family war?
Very carefully.
Yeah, say someone has lived in a trust property for 8 years, paying a flat 6,000 rand a month with no lease.
Yeah,
And the current market rate has jumped to 14,000 rand.
a huge jump.
If the trustees just slide a 14,000 rand invoice under the door next month, the family dynamics are going to explode.
Oh, transition out of these legacy risks requires intense diplomacy and rigorous process. You cannot just demand double the rent overnight.
So what's step one?
The first step is for the trustees to get an estate agent to formally and objectively confirm that 14,000 rand market rate.
Take the emotion out of it.
Exactly. The trustees then hold a formal meeting and minute a resolution acknowledging that the historical arrangement was a governance failure.
They essentially have to admit they dropped the ball.
Complete transparency is required. They formally communicate this failure to all the other siblings, apologizing for the oversight.
Wow.
Then, they sit down with a tenant beneficiary and present the objective valuation. They require a formal lease to be signed, but crucially, they phase the rent increase in over a period of time, say 12 months.
So the rent goes up by roughly 660 rand a month over a year to slowly bridge that gap,
Exactly.
rather than hitting them with an 8,000 rand spike all at once. The tenant gets time to adjust their budget, the trust finally starts generating proper income to satisfy SARS, and the other siblings know that Farmis has been restored.
It is really the only way to unwind a legacy mistake without destroying the family. Because if you don't fix it, SARS has an entire matrix of red flags they look for during audits.
Like what?
If your rent is significantly below market value, red flag.
Right.
If there is no documented lease agreement on file, red flag.
And I imagine if the rent never increases year after year despite inflation, red flag.
Exactly. But the most dangerous one is a pattern of non-payment.
Oh, of course.
If a tenant misses rent for 3 months and the trustees take zero action because it's just family, SARS will argue that the lease is a sham.
It's not a real lease.
Right, it lacks commercial substance.
Yeah.
If you would evict a stranger for not paying, you have to be willing to hold a beneficiary to the exact same standard.
Well, if we are treating this as a strict commercial lease to keep SARS happy, doesn't that change who pays for what on a practical level?
What do you mean?
For example, insurance. If the trust owns the trust pays the building insurance. But if a geyser bursts in the roof and ruins the tenant's expensive laptop and all their furniture, the trust insurance is not going to cover personal belongings, right?
No, absolutely not. The beneficiary needs their own separate contents insurance, just like any other tenant.
Makes sense.
And liability is another major factor. If a visitor slips by the pool and gets injured, who is legally liable? The trust or the tenant who invited them over?
That sounds messy.
A comprehensive formal lease agreement dictates all of this. It also provides the legal framework if things go irreversibly sour, say a family member loses their job, refuses to move out, and starts letting the property fall into disrepair.
Which happens.
It does. Without a lease, the trustees are paralyzed. With a lease, they have the legal grounds to step in and protect the family's core asset.
Which actually leads to a really positive long-term strategy for beneficiaries who are renting the rental-to-purchase pathway.
I love this strategy.
It's so clever. Let's say a beneficiary is renting a trust property now, but their ultimate goal is to buy the house from the trust and own it in their own name. A family might structure it where the beneficiary rents for 3 years at market rate. But in years 4 and 5, the trustees agree to credit 50% of that monthly rent toward a deposit to eventually buy the property.
It is a phenomenal forced savings mechanism. The beneficiary is building equity toward a deposit, the trust continues to generate compliance-friendly income, and the other siblings have total visibility on exactly when and how the asset will be sold at a fair, independent valuation.
It removes all the guesswork.
Totally removes it.
Now, navigating all of these pathways, fixing old handshake deals, structuring the Section 7C tax math, drafting compliance-heavy leases, calculating marginal tax distributions.
It's a lot.
Trying to DIY this as a family is terrifying. The margin for error is razor thin, and a single mistake can cost you hundreds of thousands of rands in penalties.
Which is precisely why relying on a dedicated trust consultant is imperative.
Absolutely.
It goes far beyond filing an annual tax return. A specialist consultant designs the architecture. Someone like Lumka Sturman, for example, you can check out her work at lumkasturman.com. Professionals like that determine the correct defensible market rental methodologies.
Right.
They draft lease agreements that are specifically tailored for the unique complexities of trust beneficiary relationships. They structure the tax-efficient distributions to ensure no one pays a cent more in tax than legally required.
Yeah.
And they stand between the trustees and SARS when the audit inevitably comes.
It is like trying to build an actual physical fortress. You wouldn't pour the concrete for a massive retaining wall yourself if you didn't know the structural load limits.
You'd hire an architect.
Exactly. A professional removes the emotion from the equation, giving you the objective framework to defend your decisions to both the taxman and your own family members.
Well said.
So, to summarize our deep dive today for you, trusts in South Africa are phenomenal vehicles for protecting and growing your family's wealth. But the golden rule is completely non-negotiable.
Absolutely non-negotiable.
If a beneficiary lives in a trust property, they must pay an arm's-length market-related rental. You can use clever, entirely legal distributions to lower their effective cost of living later, but that initial lease must be strictly commercial to maintain fairness among siblings and keep SARS at bay.
The mechanics are clear, but this raises an important question, and it's something I think every family-building generational wealth needs to ponder.
What's that?
We establish these trusts fundamentally to support and protect our families. But when the law forces us to formalize these boundaries, when you have to look your own sibling or child in the eye and make them sign a strict commercial lease or threaten eviction from a childhood home to satisfy a tax code, does creating that cold corporate structure actually make the family more united by removing the unspoken resentment?
I think we're
Or does it fundamentally change our very definition of what family support means in the modern era?
Wow, it really forces you to ask whether the fortress you built to keep the outside world at bay is subtly changing the way you interact with the people living inside it. Thank you so much for joining us to explore this incredibly nuanced topic. Take a hard look at your own trust structures, start having those difficult but necessary family conversations, and we will catch you on the next deep dive.